A quick tour of property flip or hold for real estate investors to analyze, calculate, and compare profits when flipping versus holding a property. No complex calculations, no long drawn out analysis. Welcome to Property Flip or Hold. I'm going to give you a quick tour on how to enter a property, analyze it to see if it's worth flipping, taking your profit now, or holding it and renting it for passive income. Let's go ahead and add this property. I already entered some information in, so you don't have to watch me type. And let's go ahead and add this property. Now, this particular property is worth about $306,000. That's the after repair value, the ARV. It needs only about $20,000 worth of repairs. We already have our taxes of $2,100 and our yearly insurance of $1,100. Now it's going to cost us about $100 a month of holding cost. You put on your electricity, your water, and so on. We're going to need about 2 months for the rehab period and maybe 1 month for the listing period. Under the maximum purchase price, it defaults to 20% profit that you would like to make. In this market, that might be a little bit too much, so I'm going to change this to about 15%. And again, you can adjust that to your liking. The also pre-filled in is the 7% projected soft cost when the property is rehabbed. And when we sell it, we have some selling cost, realtors, closing costs, and so on. It's already taken into consideration the holding cost of 3 months for $300. Taxes, $525 for 3 months, insurance of $275 for 3 months, and it's saying, okay, according to this, your maximum purchase price, let me move this out of the way, is about $217,000. Now let's go ahead and enter our projected sales price, which would be the same as our after repair value of $306,000. Now it's suggesting with the numbers that we've put in right now that we shouldn't pay more for the property, $218,000. I'm just going to go ahead and put $218,000 for now. And if you notice, as you fill in the information, now it also knows what your purchase closing costs are going to be. And the maximum purchase price section is saying, okay, you're also going to have another $4,000 in the closing cost. So it's saying it's lowering the value of what our maximum purchase price should be. For now, I'm going to leave it at $218,000. Let's go ahead and turn on the mortgage. We're going to get a mortgage to purchase this property. And let's go ahead and so we're going to have a 30-year term. We're going to put 20% down. And the interest rate we're going to get from a hard money lender, about 10% and 1 point. Now let's go ahead and, it's already, if you notice, it's calculated how much cash is needed at closing, which is about almost $70,000. You need about almost $5,700 here for holding costs for the 3 months that we're going to have the property. Your holding cost of $100 plus taxes, insurance, and so on, mortgage costs that you're going to have during those 3 months. But it's also calculating for us our equity at closing, what our profit is going to be. When you purchase your property, you're making your profit there. So if the property is worth $306,000 and we're taking into account the repairs and everything else that costs to hold it and then flip it, at closing, would make you a profit of about $61,000. Now let's go ahead and go to the hold section. And let's go ahead and put in the gross rental income. And in this case, this property can rent about $2,300 a month. And it's already filled in for us, the property management 10%. You can adjust that for your area. It might be 8, 9%, maybe less. I'm going to leave it at 10%. And if you notice, all these different calculations are already done for you. I'm going to go ahead and click on the mortgage refinance. So if, let's say, this is the hold tab, in other words, we're going to not flip it, but we're going to hold it. So once the 3 months are done and whatever period is left we want to refinance this property, what would the mortgage be? So let's go ahead and do a 30-year amortization. Let's leave 25% of our equity in there. So it would be a loan-to-value loan of 75% from the after repair value. That we were able to get about a 4% loan and 1 point for your points to get the mortgage. And if you notice, all these different calculations is telling us that once we enter this information, our cash flow per month, after all our expenses, after all paying taxes and insurance, property management, paying the mortgage, we're going to have a cash flow of about $600, which is incredible. Usually I look for about $200 to $50, $300, $400 profit per single family house. And so this house would definitely be worth looking at because that's incredible on the profit per month. Now, if you look on the side, we have two different columns here. We have our flip and hold columns. On our flip side, we can kind of see that if we hold this property for 3 months and we're able to keep our schedule and flip it, we will be available to make about $35,000 in profit. But it's also showing you here that, let's say if it takes us 6 months instead, as you can see, our profit go lower. Now we can go down to $29,000. But if maybe you can only flip it in 2 months, you might be able to make more profit. And again, all these are estimates depending how long it takes to rehab and then sell the property. And you can also see all the different details on the maximum purchase price and how it's arriving at the $208,000. Now let's look at return on investment. Our projected profit, if we stay on schedule for 3 months, is going to be about $35,000. Our total cash investment in this property was about $75,000. If I go back to the flip tab, it's taking the $69,007 plus the almost $5,700 cash needed for the 3 months, and that's arriving at our total investment. So our return on investment would be about 46%, which is tremendous. And if you analyze that ROI, it'll be about 185%. Let's look at our hold column. On the hold column here section, we can see all our numbers. We can see our cash flow. We can see our gross income, our effective gross income, operating expenses, our net operating expenses, our NOI, what our mortgage cost is going to be per month. Each year, how much this property we can expect to make. In this case, about $7,200 the first year, and the second year, and so on. You know, with the long-term projections here, the appreciation, the income increase of 2%, expense increase of 2%. It takes all that into consideration. And this is my favorite part of the program, is the flip versus hold profit timeline. And this is what I use every time I analyze a property. And what this does is very simply compare, if I flip the property, I'm going to make about $35,000 in about 3 months. Of course, you got to pay income taxes and so on that. But if I decide to hold it, it would take about 4.9 years to make the same amount of profit. But we also refinanced. So we have about $75,000 cash into the property. And if we refinance, we will only leave about $22,000 into the property, which means we took back about $50,000 or so when we refinanced that cash out, which means our return on investment our first year is going to be about 235%. And our cash on cash is 32%, which in my opinion is great return on investment like this. And let me just go ahead and scroll down a little bit further for the hold section. We also have additional return ratios. And you can also look at here that you have a payback period in years of 3.8 years, which means it would take about a little bit over 3 years to have our money, the $22,000 that we have in equity in this property, to receive back. After that, we have no more money into the property. It's all, continuing profit. Our cash on cash return is 32%, and we saw up there. Our cap rate, and if you notice, I moved my mouse over the little question mark, the little help. Each section gives you a help, a description of what the item is, and the calculation how we arrived at. And you can also click on the major help, and it gives you a full section of all the different formulas that are used. You can see all the different calculations: return on investment on the first year of 235%, and return on investment on year 5, which would be about 625%. Our internal rate of return on first year would be the same, 235%. Internal rate of return on the 5th year would be about 61%. And we got our rent to value, our rent multiplier, our break-even ratio, which this is a tremendous ratio to look at. What this means is we looked at before, let's say we have 5% vacancy factor, what would our income be? What this is saying, the break-even ratio, is that even if we have almost 30%, a little bit over 30% of vacancy, this property can still break even and continue to pay for the mortgage, taxes, and insurance. So that's a good ratio that the lenders also look at. And we also have the debt cover ratio. Usually lenders look at 1.2 or above. This is 1.5, which is very good. You get your debt yield, your net yield, returns. Now let me go ahead and save. Now we can also look at the reports here. And why don't we go look at the lender funding summary? What this does, it creates a little section here that can actually hand to a private lender, a hard money lender, a lender, a bank. They say, look, I'm looking for this particular loan. I'm looking to purchase this property, $306,000. It's $306,000 after repair value. I'm looking to purchase $218,000. I'm looking for you, lender, for about $174,000, which is about 55% of the after repair value. At closing, I'm going to have an equity of about almost $62,000, and the cash that I'm going to need at closing is about $70,000. And to you, lender, your interest income for those 3 months here that it's going to take to rehab and list it is going to be about $4,300, and the 1 point that I'm going to pay is about $1,744. So your total income during those 3 months is about $6,100. So your lender return on investment is about 3.5%. But what they look at is the annualized ROI, return on investment, which would be 14%. And that's what they look at. And they look at their finance and say that what kind of mortgage we're looking for, 30-year term, 20% down, which is at 80% loan to cost ratio, and a loan to value is almost 57%, which is excellent ratio. You know, the bank is going to feel very safe on that. We're saying that we're looking at 10% interest rate, 1 point at closing there, and the loan amount we're looking for is $174,400. Let's go to the summary. On the summary, you can print out the details of the flip and the hold evaluation. So you can take a look at it and have a one-page return that you can decide whether this property is worth flipping, worth holding, and holding for passive income. You're refinancing, you are taking cash out, like, you know, the Burr method, or this property is not worth flipping or renting. Go ahead and close this. And this is a very quick overview on how you can compare the flip versus hold. In the next videos, I'm going to create one just to analyze a flip only, and also to analyze just a hold property. And we'll take a look at residential and also commercial properties. Thank you so much.